Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're looking at the latest report from Royal LePage, which highlights a sluggish start to the spring market in Ontario's cottage country. Steve, what do you make of this report?
Well, Janine, it seems that despite lower interest rates and a gradual increase in inventory, the demand for recreational properties hasn't picked up as much as one might expect. The report indicates that the weighted median price of a single-family home in Ontario's recreational property market decreased by 1.5% year over year to $640,700.
It's interesting how despite these price dips, properties are sitting on the market longer. I wonder if the political climate and economic uncertainties are making potential buyers hesitant. Pauline Unger from Royal LePage mentioned that in the Rideau Lakes region, the average days on market have increased to 61 days from 49 last year.
That's a significant increase, Janine. It seems that even with more options available for buyers, the confidence to purchase isn't there yet. And let's not forget about the impact of short-term rental restrictions. Many cottage owners rely on renting out their properties to offset costs, but growing restrictions in several regions make this challenging.
Yes, and it's not just about offsetting costs. For some, renting out their cottages is a significant source of income. These restrictions could deter investors and those looking to lease properties when they aren't using them. John O'Rourke from Royal LePage noted that strict regulations continue to deter investors and that most current buyers are end users seeking personal vacation use.
Exactly, Janine. It seems like winterized cottages with strong internet connectivity remain the most sought-after properties. They offer flexibility for remote work, which is a big plus in today's work environment. However, if policies continue to restrict the recreational market, it could have a negative impact on local economies reliant on seasonal tourism.
I agree, Steve. The balance between regulation and economic growth is delicate. Phil Soper, president and CEO of Royal LePage, warns that severe restrictions can discourage buyers and harm local economies. It's a fine line to walk, ensuring affordability and community welfare without stifling market activity.
Nationally, the recreational property market seems to be showing stronger growth, with a forecasted increase in the median price of single-family homes by 4% in 2025. In contrast, Ontario's forecast is a modest 1% increase. It highlights the regional disparities within Canada.
Absolutely, Steve. And as we see in Atlantic Canada, where prices appreciated by 12.6% last year, regional factors play a significant role. It's a reminder that while trends can be national, local nuances are crucial in understanding market dynamics.
It looks like this spring is shaping up to be quite interesting for mortgage seekers, Janine. We've got fixed mortgage rates continuing to fall, largely due to declining bond yields and increased competition among lenders. It's a great time for those looking for fixed-rate deals, as some banks have even trimmed rates by up to 20 basis points for 3- and 5-year terms.
That's right, Steve. It's encouraging for potential homeowners who prefer the stability that fixed rates offer. But, as we know, not all borrowers are seeing the same relief, especially those eyeing variable-rate mortgages. While the Bank of Canada recently cut its overnight rate, lenders are reducing their discounts on variable rates, making them less attractive.
Exactly, Janine. It seems lenders are trying to balance their loan portfolios by trimming those variable rate discounts. Ryan Sims, a rate expert, mentioned that as more borrowers shift towards variable products expecting further rate cuts, lenders are adjusting their pricing to manage their exposure and the rising cost of hedging.
It's a bit of a balancing act, isn't it? For borrowers, the allure of potential savings with variable rates might be tempting, but the reduced discounts make it a tougher decision. And as Sims noted, hedging costs can rise, acting as a kind of insurance for lenders when demand for variable rates spikes.
Yes, and while this might seem like a setback for those considering variable rates, it's crucial to remember that every mortgage decision is personal. Borrowers need to weigh these factors carefully, considering their financial situation and risk tolerance.
Absolutely, Steve. It's about finding what works best for each individual's circumstances. And with the spring market being as competitive as ever, it's a good reminder for borrowers to shop around and consult with their mortgage brokers to secure the best possible rates and terms. Steve, it looks like the Bank of Montreal is making waves in the mortgage industry by tightening its lending rules for borrowers in certain industries affected by tariffs. What are your thoughts on this move?
Janine, BMO is certainly setting a precedent here, and it might be a strategic move in response to the economic uncertainties posed by the ongoing trade tensions between the United States and Canada. By adjusting their lending criteria, especially for industries like steel and aluminum, they're trying to manage risk effectively. It's a classic example of a bank recalibrating its risk profile in volatile times.
It seems like a cautious approach, Steve. Leah Zlatkin from Mortgage Outlet mentioned that other banks might be quietly doing the same thing. This move by BMO could just be the start of a trend among other financial institutions trying to protect themselves from potential economic fallout.
Absolutely, Janine. BMO's decision to lower the total debt service ratio for self-employed borrowers in these industries is a clear signal. They're being more selective about their lending, which could be seen as a prudent step given the current economic climate. However, it's important to note that this isn't an unprecedented action. Banks often adjust their lending parameters during periods of economic flux.
I can see how this might be a double-edged sword, Steve. On one hand, it's a protective measure for the bank, but on the other, it could make it more challenging for people in these industries to secure mortgages. Kyle Seaback from the Conservative Party mentioned that this could make loans harder to come by for workers at a time when they're already facing significant risks due to tariffs.
True, Janine. While it might be tougher for some borrowers, BMO is also known for its competitive pricing and niche products, particularly in the rental market. So, while they might be curbing their appetite in certain sectors, they still offer a lot of value in others. It's about balancing their portfolio and ensuring long-term stability.
And with other sectors like transportation, construction, and utilities also on BMO's list of limited appetite industries, it highlights the broader caution across various economic sectors. It's a reminder of how interconnected our economy is and how banks must navigate these complexities.
Exactly, Janine. As David Larocque pointed out, this adjustment by BMO might be minor, but it's likely a sign of things to come. Other lenders could follow suit as they reassess their risk exposure. It's a dynamic environment, and borrowers need to stay informed and possibly consult with their mortgage brokers to understand how these changes might affect them.
Steve, it's always inspiring to hear about companies that are making a difference in their industry, and today we've got some exciting news about Nesto. The Canadian Mortgage Professional has recognized Nesto as a top mortgage employer for 2025. This accolade really highlights their commitment to creating a supportive and innovative work environment.
Absolutely, Janine. It's a significant achievement for Nesto, especially considering the competitive nature of the mortgage industry in Canada. Being acknowledged by CMP is no small feat. It shows that Nesto is not only focused on providing excellent services to their clients, but also on fostering a positive culture for their employees.
And it seems that Nesto's dedication to its workforce is a key component of their success. Marie-Eve Bernard, the Senior Vice President of Human Resources at Nesto, mentioned that they believe talent is the cornerstone of their success. By listening to and empowering their people, they're able to drive innovation and unlock potential.
That's right, Janine. Nesto's approach of leveraging technology to enhance their employee experience is noteworthy. They're using their proprietary technology platform, fueled by artificial intelligence, to create seamless and efficient mortgage solutions. This not only benefits their clients, but also empowers their staff to excel in their roles.
It's clear that Nesto is committed to building a strong company culture that promotes collaboration and professional development. This award not only recognizes those efforts, but also solidifies Nesto's position as a leading employer in the Canadian mortgage sector.
Definitely, Janine. With over $63 billion in mortgages under administration, Nesto is a major player in the market. Their focus on innovation and employee satisfaction is likely a driving force behind their impressive growth and success.
It's a great reminder of how important it is for companies to invest in their people and create a positive work environment. Congratulations to Nesto on this well-deserved recognition.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.